Afternoon, student. Today's topic would be cost of capital. Yesterday we have done the payback period, internal rate of return. All these things have been discussed in the previous class, and few more things were left, like merits of IRR, demerits of IRR. These things are purely theoretical portion, which you can refer to your study material and you can find it very easily. Now, few things that I want to discuss, like the comparison between NPV and IRR, or in examination it might be asked that what are the differences between NPV. NPV stands for net present value method, and IRR. IRR is internal rate of return. So let me just brief you. Under the NPV method, the first point is interest rate is known. Interest rate is a known factor, but in the case of IRR method, interest rate is an unknown factor. The second point is, under the NPV, it involves computation of the amount that can be invested in a given project so that the anticipated earnings will be sufficient to repay this amount with market rate of interest. But in case of IRR method, it attempts to find out the maximum rate of interest at which funds are invested in the project. Earnings from the project in the form of cash flow will help us to get back the funds already invested. Third point would be, under the NPV method, it assumes that the cash inflows can be reinvested at the discounting rate in the new projects. Discounting rates I have already discussed, which is also known as factoring rate or factoring. Under the IRR method, it also assumes that the cash inflows can be reinvested at the discounting rate in the new projects. Then again, in under the NPV, the fourth point would be reinvestment is assumed to be at the cutoff rate, and under the IRR method, the reinvestment in funds is assumed to be at the IRR. So with this, we are ending this topic, and now I would be discussing the cost of capital. So, what does it mean by this cost of capital? The cost of capital as a concept and tool of financial making decision plays an important role not only in capital budgeting decisions but also in planning and designing the capital structure of a company. Capital of a company is composed of funds obtained from a number of sources. As is well known that some sources of capital may be costlier, but they may give the benefit of right to vote and control in the firm. So what does it mean by this? Right to vote and control in the firm. It is indicating that it is talking about the equity shares. So equity shareholders are having the voting rights. They can vote to to elect the members of the company, as well as they also have got the controlling power in the management of the company. On the other hand, there are certain other sources of funds which may be comparatively cheaper, but at the same time are devoid of the right to vote, like debenture holders. They don't have, for example, debenture holders, they don't have the voting right, and they do not have what we can say the controlling uh, power also, are devoid of the right to vote and control in corporate management. Despite their low cost, such funds may be more risky for the company, especially during low income or no income years. When the company is in the zone of making no income or low income, in those periods, these sources of capital are very risky. Why? If Because if the company is not able to pay their interest or installment or whatever the obligations the company is having, that debenture that loan holders or the debt holders, what they would do, they will be suing the company. Thus, the importance and relevance of each of the capital funds, so far as their cost is concerned, can only be understood in the context of their implications as income. Now, what is cost of capital? Cost of capital is basically the price which a firm pays for the use of funds obtained or borrowed. So, what are the kinds of capital? Capital can be like owned capital and borrowed capital. What are the owned capital? Owned capitals are like equity share, preference shares. These are reserves and surplus. These capitals are called owned capital. What are the borrowed capitals? Loans, term loans, debentures. These are called the borrowed capital. It is the minimum rate at which must be earned on invested funds so as to cover the price and other related costs. Now again that according to Ezra Solomon, cost of capital is the minimum required rate of earning or the cutoff rate for capital expenditure. So according to Ezra Solomon, what he is saying, the definition would be cost of capital is the minimum required rate of earning or the cutoff rate for capital expenditure. This means that if the expected earnings rate of new investment proposals is less than the average cost of capital or the cutoff rate, then such investment proposals should not be accepted. It is a logical point as well as we can say that from the definition itself, it is indicating that if your business is not able to earn to the extent of the cost of capital, then what kind of projects you are into, what kind of business are you into? So these have to be seen. Now the next thing comes the types of cost of capital. So in this context, it will be worthwhile to be conversant with the meaning of different types of cost of capital. Number one is historical cost and future cost. So what it is? Costs that have already been incurred in financing a project are called historical costs. So what is historical cost? Historical costs are basically costs that has already been incurred by the firm in financing a project are called historical costs. On the other hand, costs expected to be incurred in future, such as interest or dividend payment on loans or equity shares raised for financing a project, are called future costs. Now, next thing is explicit cost and implicit cost or opportunity cost. So, what is the explicit cost? The explicit cost of any source of capital may be defined as the discount rate that equates the present value of the cash inflows with the present value of the cash outflow. Now, it is thus the internal rate of return, which is the explicit cost of capital and which has to be paid by the firm raising additional finance. In case a, in case a mode of finance does not involve any burden such as, what are the burdens? Like interest free loan, then related explicit related explicit cost will be 0% because there is no because there are no associated cash outflows in that case. Now next thing is average cost and marginal cost. What does it mean by this? Average cost of capital is the weighted average of a specific costs of various sources of capital. The weights are assigned according to the proportion of each sources of capital in the capital structure, whereas the marginal cost is the cost of obtaining incremental unit of new capital raised by the firm. When additional finance when additional finance to be raised involves more than one source of capital, suppose the business is already having the capital structure. Now, due to the expansion or some other reasons, the company or the firm is willing to have some more capital. So, in that case, when the additional finance is to be raised, it involves more than one source of capital, then the average of a specific marginal cost can also be computed for the new sources of capital. The next point is specific costs and composite costs. Let us see what it is. Cost of capital can be computed for a specific or each source of capital, such as cost of borrowed capital or cost of equity share capital. All these are called specific cost of capital. So what are the specific cost of capital? The cost of capital can be computed for a specific or each source of capital, such as cost of borrowed capital. So these are known as specific cost of capital. As distinct from specific cost, there can be composite cost also, or composite cost of capital, which is an average of all the specific cost of funds inducted into the capital structure of a company. Now let us see what are the importance of cost of capital. The importance of cost of capital now I would be discussing. So, although it is rather difficult to calculate the exact overall cost of capital of a firm, yet its role in financial decision making is now universally recognized. So, the importance of cost of capital, the points would be capital budgeting decision. Cost of capital of a firm serves as a cutoff or the minimum rate below which no capital investment proposal should be accepted. So there must be a cutoff rate or the minimum rate of the cost of capital below which no capital investment proposal should be accepted. अगर आपका कॉस्ट ऑफ कैपिटल जितना है उससे कम का अगर आपका रिटर्न आ रहा है इन्वेस्टमेंट प्रपोजल पे तो वैसा प्रपोजल को एक्सेप्ट नहीं करना है. In discounted cash flow or DCF method, cost of capital is used as a discount factor for finding out the present values of future cash flows and to ascertain the net present value of an investment proposal or project. Now, the next thing is coming that optimum capital budgeting decisions can also be taken by comparing the internal rate of return of a project with the average or overall cost of capital of the firm. The second point is capital structure planning decisions. And under the importance of cost of capital, the second point is capital structure planning decisions. So every firm wishes to plan and design a capital structure which may prove most optimal. Cost of capital can be used for comparative study of various financial resources. Cost of capital can be used for comparative study of various financial resources. This can be helpful. This can be helpful in arriving at an ideal mix of debt and equity so as to minimize the overall cost of capital and maximize the market value of its shares. So, as a finance manager, what you need to see from the angle of this cost of capital, that maximization of the market value of the shares of the firm as well as minimizing the overall cost of capital of the firm. Next point is, that is third point, other financial decisions. In addition to the above, concept of cost of capital is useful to top management in working capital management. It is the top management of the organization or of the firm. They also are interested in knowing about the cost of capital, the arrangement of short-term finances and investment in current assets, etc. Now, evaluation of financial performance of top management. Next point is evaluation of financial performance of top management. Once a project is implemented or commissioned, implemented और commission मतलब एक project जब implement हो गया अब उसको execute करना है. A comparison of actual cost with the estimated और budgeted cost. आपने जो बजट बनाया था पहले से कि ये प्रोजेक्ट इतना वाइबल है, इतना रिटर्न देगा, इतना पे बैक पीरियड है, उस प्रोजेक्ट का आपने एक एस्टिमेटेड बजट बनाया था, बजटेड बनाया था, उसको कंपैरिजन करेंगे एक्चुअल फिगर से टू इवैल्यूएट द परफॉर्मेंस ऑफ द प्रोजेक्ट. नेक्स्ट इज point number 5 is allocation of national resources. Cost of capital helps in uh, rational allocation of resources to various projects of national importance, which is important for growth of any economy. Now there are certain factors or determination of cost of capitals. So how the cost of capital is determined? So a company obtains funds from various sources. A company can obtain the funds or source the funds from various sources. So what are the sources? Number one is borrowed capital. The second is preference share capital. Third one is equity share capital, and fourth is retained earning. So cost of capital is different for each source. So if you are sourcing the capital from equity share, for by issuing equity shares, the cost will be different. Cost of capital will be different. If you are sourcing it through preference shares, the cost would be different. If you are sourcing through borrowed capital or retained earning also, the costing part of the capital would be different in each case. And while determining the cost of capital first, a specific cost of each component of capital is computed, and then combined or composite cost of capital is computed as weighted average cost. Now let us discuss about the cost of debt or borrowed capital. So what is cost of debt or borrowed capital? So borrowed capital and cost of borrowed capital is the capital which you are borrowing from some other organization. ठीक है. So cost of debt is the percentage of burden in relation to net proceeds. Net proceeds का मतलब क्या हुआ? सेल्स करके जो फिगर आता है that is proceeds. So cost of debt is the percentage of burden in relation to net proceeds. In this context, burden can be defined as, what is the burden? The burden can be defined as the annual rate of interest agreed to be paid plus other related cost. आपने जिससे borrowed capital borrow किया है उसके साथ जो एग्रीमेंट हुआ है आपका कि इतना परसेंटेज इंटरेस्ट आपको देंगे, सो वही हुआ बर्डन. और कुछ अगर अलग से भी अगर कोई कॉस्ट है तो वो भी उसमें जुड़ जाएगा. It is a usual practice for a company to procure borrowed funds by issuing debentures or bonds. So कैसे कंपनी borrowed capital लाती है? By issuing debentures, either by issuing debentures or by issuing bonds. While doing so, the amount of net proceeds which the company actually receives is less than the face or par value of such debentures or bonds. Now, cost of borrowed capital can be subdivided into two parts. So, number one is cost of perpetual debt and cost of redeemable debt. So, cost of perpetual debt क्या है? परपेचुअल डेट रेफर्स टू नॉन रिडीमेबल, मतलब ऐसा वो चलते रहेगा, सालों साल तक रहेगा वो. परपेचुटी टिल द एंड ऑफ परपेचुटी. सो परपेचुअल डेट रेफर्स टू नॉन redeemable perpetual debt or debentures, which means that there is no maturity date and such a debt may go on perpetually over the lifespan of the loanee company. So, and the next one is, this is before tax of debenture or debt. Virtually, interest paid on borrowed capital is treated as deductible expenditure so far as tax calculations are concerned. And the as I explained, that cost of borrowed capital can be divided into two parts. One is cost of perpetual debt that I have explained. Another point is cost of redeemable debt. So what is cost of redeemable debt? Redeemable debt or debentures or bonds are for a specific term. So term may be like for 7 years or 10 years. So after 7 years or 10 years, it may be redeemed. But in the case of perpetual debt, there is no any time limit, and it goes on till the maturity of the what? Maturity date, and it, it goes up to the maturity date of that instrument. Now, so but in case of this redeemable cost of redeemable debt, usually the specific terms are for 7 years to 10 years, and after which repayment or redemption is made on maturity. 7 से 10 साल के बाद क्या होता है, इसका मैच्योरिटी हो जाता है और आपको पे करना होगा. सच रिडम्पशन में एट पार और डिस्काउंट और प्रीमियम, उस डिवेंचर को रिडीम जो किया जाएगा एट पार कर किया जा सकता है, एट प्रीमियम किया जा सकता है और एट डिस्काउंट किया जा सकता है. तो इसका मतलब क्या हुआ कि 10 रुपए की चीज को अगर 12 रुपए में रिडीम किया जाएगा तो इट विल बी सेड दैट इट इज रिडीम्ड एट premium. If it is redeemed at the rate of rupees 8, then it will be said that it is redeemed at discount. And if it is redeemed at rupees 10, then it will be said that it is redeemed at par. So this is what they are saying. While calculating the cost of long-term debt, proper adjustment have to be made for variation in face value and the issue price. Now, many a time companies make debentures or bond issues at a discount. कंपनी क्या करती है, डिवेंचर या बॉन्ड को इशू करती है डिस्काउंट में. इन सच केसेज द इशू प्राइस इज केप्ट लेस देन द नॉर्मल और फेस वैल्यू. इशू प्राइस उस केस में क्या होता है, कम रहता है फेस वैल्यू से. Although on maturity the full value has to be repaid to the investor. In such cases, a pro rata or proportionate amount is added to the annual interest or deducted from the interest. Now the next thing is cost of preference share capital. So what would be the cost of preference share capital? Preference share is a mixed type of security. What it is? Preference share is a mixed type of security. It has certain common characteristics of debentures. On the other hand, it has also the characteristics of equity shares. On the other hand, so dividend on preference share capital is fixed, as in the case for interest on debenture capital. जैसे डिवेंचर कैपिटल में इंटरेस्ट फिक्स रहता है, वैसे प्रेफरेंस शेयर में भी डिविडेंड का रेट फिक्स रहता है. ऑन द अदर हैंड, पेमेंट ऑफ डिविडेंड ऑन प्रेफरेंस कैपिटल इज नॉट ऑब्लिगेटरी. प्रेफरेंस कैपिटल और प्रेफरेंस शेयर के केस में जो प्रीफिक्स्ड है आपका डिविडेंड का रेट, लेकिन वो पेमेंट करना ऑब्लिगेटरी नहीं है, एज इन द केस ऑफ इंटरेस्ट ऑन बॉन्ड. जबकि बॉन्ड के केस में या डिवेंचर के केस में इंटरेस्ट पे करना कंपलसरी है, ऑब्लिगेशन है. Moreover, like dividend on equity share capital, dividend on preference share capital can be paid only out of profits of the profit after tax. So डिविडेंड के केस में क्या है, प्रॉफिट आफ्टर टैक्स जो बचा हुआ है उसी में से आपको डिविडेंड पे करना है. Hence the benefit of saving in tax is available to a profitable firm in the case of debentures or borrowed capital. Preference shares are of many kinds, such as irredeemable preference share or redeemable preference shares, and non-cumulative and cumulative preference shares. So cost of redeemable preference shares, how it is calculated? Cost of redeemable preference share capital. Redeemable preference shares are issued for a definite period, after which they are redeemed or repaid. So क्या है ये, एक डेफिनेट पीरियड के लिए इशू किया जाता है, उसके बाद इसको रिडीम किया जाएगा या रीपे किया जाएगा. इन दिस वे they have a maturity date. उसमें maturity date पहले से ही लिखा रहता है. The method of computing cost of such shares in similar is similar to the method used for calculating cost of debenture or uh, the method of computing cost of such shares is similar to the method of used for calculating cost of debenture or debt capital. The formula is like small d plus issue cost divided by MP within bracket. Now whole divided by P plus small n plus small n small p divided by 2 multiplied by 100. This is the formula where C represents cost of such capital. Small d stands for fixed annual dividend. M small p stands for maturity period in years, and small n small p for net proceeds. Unlike interest on debt capital, dividend payable on preference shares is not allowed as expenses for the purpose of income tax. So this is what they are saying. Now the next point is cost of equity share capital. So what are the cost of equity share capital? Now computing the cost of debt or preference share capital is comparatively an easier task. So calculation of the preference share capital, cost of debt or preference share capital is comparatively an easier task because cash outflows in respect of interest or dividend are fixed and obligatory. But in case of equity share capital, neither the rate of dividend is fixed nor it is obligatory or legally binding on the company to pay dividend. That is why some people may have the impression that equity capital does not involve any cost, but such an impression will be far from the truth. In fact, equity capital also involves costs by implication because the shareholders expect from the management fulfillment of certain expectations in respect of their investment in such cases. Now, these expectations are that management will earn at least the return on their capital which will provide them. It is expected that the management will be earning a profit, earn at least that return on their capital which will provide them, number one, a regular stream of earning per share or EPS, a regular stream of earning per share or EPS, a regular stream of dividend per share, that is DPS, growth in their future EPS and DPS through gradual increase in retained earnings. Now the term thus it can be referred excuse me, that a company must fulfill the above expectations of its equity shareholders. According to Van Horn, cost of equity share capital is the minimum rate of return that a company must earn on equity financed portion of its investments in order to leave unchanged or marked price of the stock. Then certain methods are there for computation of cost of equity share capital. So cost of equity share कैसे निकालते हैं? तो पहला इसका मेथड है अर्निंग डिवाइडेड बाय प्राइस रेशियो मेथड. So earning price EPS method, EPS ratio method. Second is dividend price ratio method. Third is dividend price plus growth method growth method, and the fourth one is realized yield method. So let us see it one by one. Earning price ratio method or it is also called EPS method. This is also called earning yield method or EP ratio approach. It is based on the assumption that shareholders capitalize a certain amount of profitable future earnings on the basis of the existing earnings. So on this very thing, this assumption it is based. So the formula is capital C equals to capital E divided by P multiplied by 100, where C stands for cost of equity share capital, E stands for earning per share, P stands for market price per share. So what would be the formula? C equals to capital E divided by capital P multiplied by 100. There are certain drawbacks of assumptions of P ratio approach, which may also be called the limitations of the method. जो ड्रॉबैक है उसी को लिमिटेशंस भी कह सकते हैं. क्या है? The EP ratio approach is based on the following assumptions. Number A, that the future earnings and the market prices remain unchanged. तो ऐसा हो सकता है कि फ्यूचर अर्निंग्स एंड मार्केट का जो प्राइस है वो सेम रहेगा, ऐसा नहीं हो सकता है. और इवन इफ दे चेंज, देन द चेंज इन इज इन द सेम प्रोपोर्शन इन बोथ. तो अर्निंग में और मार्केट प्राइस में सेम प्रोपोर्शन में चेंज हो, ऐसा भी मुश्किल है. दैट द कंपनी अर्न्स द एग्जिस्टिंग rate of return on the new issue of shares, equity shares, that the entire earnings are paid to the shareholders in cash. तो जो भी अर्निंग है उसको कैश में पेमेंट कर दिया जा रहा है. Now dividend or price ratio method, DP ratio method, it is also called capital D, capital P, DP ratio method. It is also called the dividend yield method or DP ratio approach. What rate of cash returns? What rate of cash returns do the equity shareholders expect on the market value of their investment, share investment? The market value of their share, that the entire earnings are paid to the shareholders in cash. So these are the assumptions based on which the earning price ratio method is able to work. Needless to point out that in actual practice neither of the above assumptions holds true. लेकिन practically क्या होता है, ये सब assumptions काम नहीं करता है. Now dividend price ratio method, what do they say? The dividend price ratio method or DP ratio approach, what rate of tells us that what rate of cash returns do the equity shareholders expect on the market value of their share investment. जो लोगों ने शेयर इन्वेस्टर्स ने जो शेयर इन्वेस्ट किया है उसके बदले में what rate of cash return do the equity shareholders expect on the market value of their investment, share investment. This is the basic consideration behind this approach. The management must at least pay the minimum rate of cash return on shares, market values which the shareholders expect. Here again the formula is C equals to capital C equals to capital D divided by capital P multiplied by 100. So C stands for cost of equity share capital, D stands for dividend per share, P stands for market price per share. So P stands for market price per share, D stands for dividend per share, and C stands for cost of equity share capital. Now next point is dividend or price ratio plus plus growth method, which is also called as DP ratio, growth ratio. This is a better method to compute the cost of equity share capital. Authors like Gordon Donaldson and Ezra Solomon have also advocated this method. In actual practice, neither the earnings nor the dividends per share are constant. Actual में क्या होता है कि अर्निंग भी कांस्टेंट नहीं है, अर्निंग कितना भी हो सकता है, कम भी हो सकता है, ज्यादा भी हो सकता है. एट द सेम टाइम the dividend per share are also not constant. Although with the growth of the company, the EPS is bound to grow. अगर कंपनी का अगर ग्रोथ होता है तो अर्निंग पर शेयर भी ग्रो होगा ही होगा. एंड इन मोस्ट केसेज द डीपीएस टू grows grows, causing increase in the market value of the shares. In such cases, expectations of the investors in such shares are bound to go up. Thus, the dividend price approach must take into consideration the element of growth. So, what is the formula here? Capital C equals to capital D divided by P multiplied by 100 minus plus G, where C stands for the cost of equity share capital, capital D stands for dividend per share, capital G stands for the growth rate in DPS, and P stands for market price per share. As both the above, this approach or method is based on two assumptions again. So what are the assumptions? Number A, that the EPS and DPS, what is DPS? Dividend per share. That the, and EPS, that is earning per share, and dividend per share will grow at the same rate. That the EPS and at the same rate. At the that the existing price earning ratio will not change. That is also not possible. That the price of shares in the market will also behave in line with the change in earnings. As both the above assumptions cannot hold good in actual practice, this approach too is not free from drawbacks or limitations. Moreover, another limitation is that the is rate of growth in future dividend earnings cannot be precisely estimated. So फ्यूचर का जो ग्रोथ का रेट होगा डिविडेंड का उसके बारे में आप कैसे बता सकते हैं कि इतना ही होगा, ज्यादा भी हो सकता है, कम भी हो सकता है. It basically depends upon the profitability or earnings of the company. Now next point is realized yield method. So actually we are discussing what we are discussing right now currently. We are discussing cost of equity capital. Now realized yield method. This method is based on the rate of return actually realized over a period of years by an investor on his investment in the equity shares. This method is based on the what? On the rate of return actually uh, realized over a period of years by an investor on his investment in the equity shares. The rate of return actually realized serves as the required rate of return. So rate of return को क्या बोलेंगे? Required IRRR, triple R stands for required rate of return. Now, for the prospective investors in equity shares of a company, the approach rests on the presumption that the rate of return realized over a period of time in the past will be projected in future also. मतलब इस assumption पर है कि पहले जो आया था रेट ऑफ रिटर्न वही फ्यूचर में भी आएगा, ऐसा भी होना जरूरी नहीं है. The next thing is cost of new equity shares. At the time of issue of new equity shares, a company, what do they do? Usually incurs issues expenses such as underwriting commission, brokerage, etc., which are deducted from the issue of the amount of the balance from the issue of the amount, and the balance represents the net proceeds which are actually available for use in business. Now the next point is cost of retained earnings. So what are the cost of retained earnings? It is usual practice followed by corporate management to pay only a part of the profits after tax or after tax as such dividend, and to retain the remaining part in the business as surplus or reserve. So what they are saying, the cost of retained earning, it is general practice followed by corporate managements to pay only a part of the profits after tax as cash dividend, and to retain the remaining part in the business as surplus or reserves. In this way, retained earnings accumulates over the years, and thus the built up reserves. Though years, retention of past years earnings from the integral part of the owner's equity, the company does not pay any return as such to the owners of the retained earning. That is why some people regard this source of internally generated funds as cost free for the company, but it is an erroneous comparison. Now, how to measure the opportunity cost of retained earning? How to measure the opportunity cost of retained earnings? One way is to assume that the shareholders reinvest the dividend income in new shares of the same company. Then, expectations of shareholders from new equity shares of the company is the opportunity cost of retained earning. So, what they are saying, uh, one way is to assume that the shareholders reinvest the dividend amount in new shares of the company. Is it necessary? No, it is not necessary. So this is again one of the assumptions. What is the assumption? Assumes that the shareholders reinvest the dividend income in new shares of the same company. Suppose par value of equity shares of a company is rupees 100 per share and the market value is rupees 160. The company is earning per share are rupees 10. Find out, out of which the management pays rupees 6 as dividend and remains 4 as retained earning. Now comes the topic. The topic's name is what? Weighted average cost of capitals. So what do you think about weighted average cost of capital? What is a weighted average cost of capital? The composite or overall cost of capital is the weighted average cost of specific costs of various sources of funds in the capital structure company. The composite of overall cost of capital is the weighted average of specific costs of various sources of funds in the capital structure of a company. The following three steps are necessary for computing overall or composite cost of capital. To find out, so first point is the following are three steps are necessary for computing overall cost of capital. Number one is first step is find out after tax cost of a specific sources of funds such as equity share capital, preference share capital, debt capital and retained earnings. Now second point is to compute weights to be assigned to each source of capital. To compute weights to be assigned to each source of capital. The weights are assigned according to the respective proportion at which or ratio of each type of capital. The last point of this weighted average capitals, this steps is to multiply the specific weights with the specific costs and then to multiply the specific weights with the specific costs and then add the multiples to find out the overall or weighted average cost of capital. So in doing so, the two controversies that usually arise. What are they? Number one is whether a specific cost should be before tax or after tax, and whether the weights to be assigned ahead should be based on the book value. So, what do you mean by book value, and what is the difference between fair market value, book value, and fair value? See, book value basically refers to the value of the assets owned by the company within a span of time, within a certain span of time. So, this is what they are saying. book value. The market value is the value at which the goods are sold into the market. So that is the market value of each type of funds. As regards the first, it will be appropriate to take the tax cost of each source of capital. The reason for this is that the cost of equity or preference share capital is always on an after tax basis. तो प्रेफरेंस शेयर कैपिटल का कॉस्ट और इक्विटी शेयर कैपिटल का कॉस्ट निकालने के लिए आपको जो एवरेज जो कॉस्ट ऑफ कैपिटल है उसको निकालना होगा. The reason for this that the cost of equity or preference share capital is always on the after tax basis. The question of paying dividend or retaining a part of earnings arise only when tax has been deducted from the profits before tax. So this is what they are saying. Now, in today's session, the last thing for discussion is that weighted average cost of capital based upon market value and market yields. So what I am going to discuss, I am going to discuss the weighted average cost of capital based on market value and market yields. So in the above example, weights based on book values were used to compute the overall cost of capital. However, some authors are of the view that market values are some realistic and as such the as such it represents the true values of capital funds for various sources. Therefore, weights based on market values should be used in computing the weighted average cost of capital. In case weights are assigned on the basis of market values, then it would be more appropriate to use after tax market yields. So, with this, I will be ending today's session. In today's session, we discussed about the cost of capital, the entire theory, and this has been discussed by me from a book that is with me. And this message for the student of MBA, Madhusmita, that whatever material you are having, the material that was provided by the institute, please go through the chapter cost of capital with that material. Apart from that, I have also forwarded few materials, Xerox, uh, WhatsApp to ma'am. She will share, I think she has already shared that with you. Solve few questions. If you have any question or doubt in any of the question of this cost of capital that I have sent to you, please ask in the next class. And with this theory, our second unit, that is capital structure, is complete today. So unit 1 has been completed and unit 2 has been completed. In the next class, probably whenever it is, if you don't have any doubts or if you have question after solving that question, what would we do? We would be doing the working capital management, that is unit 3. Okay, thank you. Bye.